Yeah, last time what we learned was about futures. We learned about different futures, how you can, hedge your futures and make sure that you mitigate your losses to a certain extent. And with indices, with stocks, you can play futures. So after this option's done, I'll tell you how to hedge your stocks portfolio. For example, you have a portfolio Nifty 50 stocks which has options that I'll tell you how to hedge. After that, there's a second one which is options, which is into calls and puts. So if you look at this diagram, if you can see, where buy options are there, sell options. And somebody sells, only then we can buy. Remember that. Somebody selling a put or a call, only then I can buy a put or a call. So in buying options, you expect underlying price rise. That is buying a call option. If you expect an underlying price fall, that is a buying a put option. You have to understand this, a basic concept. You have to understand this. Otherwise, the next succeeding sessions will be difficult for you. So buy options. We are talking about buying when you expect underlying price rise. That is
Kochi, can you just enlarge it because I think it is we are
okay.
not in the PPT mode. Yeah.
Okay, no problem. Let me make it current slide. Is it okay now?
Yeah, fine.
Okay. So options trading, you have buying options and selling. So seller has to be there for buying and buyer has to be there for selling. So in buying, you have a call option, buying call or buying a put. When you buy a call, that means you're expecting the market to go up. Nifty 50 to go up, Bank Nifty to go up, Fin Nifty to go up, Sensex to go up. All right, mid cap to go up, all that stuff. But when you're buying a put, you're expecting the derivative to fall down, go down, anything it could be. In the same way, selling options just opposite. When you sell an option, for example, where you're selling a put, you're expecting the market to go up. In buying, when you buy a put, you're expecting the market to fall down. Remember that. When you sell a put, you're expecting the market to go up. And when you sell a call, you're expecting the market to go down. In buying, when you buy a call, you're expecting the market to go up. Anything it could be. Please. Okay. Is it clear? This has to be clear. Otherwise, it is difficult. You have questions, please ask me now. If this basic funda is not clear, then you'll have little trouble understanding the succeeding sessions. Very simple. When you buy a call, expecting market to go up. When you buy a put, expecting market to go down. When you sell a put, you're expecting market to go up. When you sell a call, you're expecting the market to go down. Something like when they sell, they call writing. Call writing means selling a call. Put writing means selling a put. These also terms they use synonymously for selling options. When you put writing means you're selling a put. Call writing means you're selling a call. Simple. Is this clear? Any
Yes,
doubt
Matthew.
in this? Please let me know if you have any doubt. But this is
I
basic.
don't have
If
a
it
doubt. I don't have a doubt, Matthew, but I think you're going to cover it further. Like basically, looking at that from a very basic perspective, uh, buying a put is looking similar to selling a call, but they are two different things, right? So I hope you're
correct. Yeah,
going to
I'll tell you. Very
dive
good.
into
Yeah, yeah, yes. Yes. I'll explain you that. Yes. So this is clear. Then let me minimize this. Let's dive in. Okay. Let's start. Okay, let me explain you. When you take any insurance company, okay, any insurance company, what they do, they give you insurance. For example, you buy a car, okay, you take life insurance, you buy a car, for example, buy a car and you pay just a premium of 10,000, 15, 20,000, but the car is worth 20, 15, 12, 10 lakhs. So The insurance companies, what they tell you is that, okay, your car is so expensive. Every year, what do? You take premium for us. We'll cover your entire car. God forbid accident happens, we'll cover your insurance. So 90%, okay, more than that. What happens every year? I'm paying insurance, but I'm not claiming insurance. Very less people claim insurance, right? And that's the reason a lot of insurance companies are making money. In the same way, if I have to tell you, when somebody sells a call option or selling a put option, it's like an insurance company. What they do, they collect a premium. Like a company, insurance company, by selling insurance, they collect a premium. A premium is very small compared to your asset. Whatever, if you take a home insurance, a car insurance, that the premium is very less. For the underlying asset value is too high. They're collecting a premium. In the same way, for option seller, they sell the option with a small premium. Okay. And why option selling has come into picture? Because it's actually came into picture to hedge your portfolio. For example, you're buying like HDFC Bank or ICICI, Reliance, or any stock. Whenever uncertainty is there, they want to hedge the stock. For that reason, actually options came into picture. Just imagine a person having a big portfolio. If they don't hedge it, what happens? The losses will be too high. So what, for example, like election, any major event, like a budget is coming up, any major event, what they want to do, they want to hedge. Initially, that is the exact reason the option came. But eventually what happened, that became a big business. NSE is making a lot of money. Government is making a lot of money because of the taxes. So option trading allows investors to manage the risk and speculate on a price movement. Understanding both buying and selling strategies is crucial for success. Yes. Yeah. Yeah. What are options? Actually, it is derivatives. From a stock, you're deriving something, a call or a put. For example, is a Wipro stock is there. Wipro stock, I can buy a call or I can sell a call, or I can buy a put or I can sell a put. Those are derivatives from Wipro. Okay. Like a curd is a derivative of milk. From milk, the curd comes, something like that. So it's a derivative. So call options, you have the right to buy. Put options, you have the right to sell. The good thing about option is whenever you buy or sell, you're not bound to buy, you're not obliged to buy that stock, or you're not obliged to sell that stock. Okay? You don't become the owner of that company. For example, you buy a stock, you're becoming a shareholder. You're like a owner of that percentage owner of that company. But when you buy a derivative, you're not. You can buy anytime and you can sell anytime. Even if you take options on a week, options are for weekly, bi-weekly, and monthly. Okay, you can, even if you buy an option on a weekly basis, for example, the week starts from Friday to next Thursday for Nifty. Friday to next Thursday, you are supposed to sell by Thursday. You can sell it on a Friday itself, or you can sell it on a Monday or Tuesday, Wednesday, Thursday, and Thursday it expires. So you can hold it for 7 days if it's a weekly expiry. In the same way, you can hold it for a monthly expiry for stocks. Okay? You have a 1 month. You can buy anytime, you can sell anytime. There's no obligation. This terminology you should understand. What is a strike price? The price at which the option can be exercised. Whatever price you're buying, let me take you to see this. Monday is a bank X expiry. Okay. What strikes 60,200? P means put. The price is 325. That is a strike price. Here, if you look at strike price at which the option can be exercised. So whatever strike, for example, in Nifty, it is like 24,000, and what price it's showing for a call or a put, that is a strike price. The premium cost of the option, the premium what you're paying for that strike, 20,400 or 24,000 Nifty or 60,200. I've shown you Bank X. What is the premium there? It's shown, I think 320 rupees. 320 rupees is a premium. That means for that week, the 320 rupees premium is there. It keeps on increasing or decreasing based on the market movement. If the market goes up, if I've short a put, if I've written a put, it goes up. But if I bought a put, it will go down if the market goes up. Remember that. So cost of the premium option. The premium is nothing but the price what I'm paying for that strike price. Expiration date, the date which the option expires. You have weekly expiries, you have monthly expiries. Monthly for stocks. All other indices, like if you take Nifty, Bank Nifty, Bank X, Fin Nifty, Sensex, it has weekly, monthly, 2 months, 6 months. You can buy up to 1 year, I think, depending upon your demat. I've seen people buying 1 year options also. Okay. Warren Buffett, all they buy long term, 1 year, 2 year term options. Clear? If you any doubt, please ask me. This is also a little important. Strike
Matthew,
price, premium, and expiration date.
Matthew, can you please go back to the chart and clearly highlight the strike price and premium? I think I'm not clear on that.
It's wait. Okay, let me show it like this to you. Nifty 50 is at what strike now? 24,530. That is a strike price, right?
Okay.
Correct. 24,530. But you can't buy 530. You have to buy either 24,550 Nifty call or 24,550 put. You can buy 24,000 also. You can buy. Okay, so this is a see this strike price of Nifty. I've got strike. What is the strike? 24,550 call. CE means call. 24,550 put. That is a strike. And what is the premium? Look at the premium beside that. 450 ka. What is the premium? 223 rupees I have to pay. If I buy it on a Monday, I don't know how about the price, but today, as of today now, for Nifty strike 24,550 CE call option, I have to pay 223 rupees. The similar way for Nifty put for a strike 24,550, I have to pay a premium of 240 rupees. Next one, 24. I'll tell you what is at the money, in the money, and out of the money. That so I'm not explaining that. So this is a strike and the premium you're paying. What happens to this premium of 223? For example, by the weekly expiry of Thursday, Nifty expiry is on Thursday. By Thursday, if Nifty is above 550, Nifty should be above 550 plus this 220. That means, let me explain here itself, then you'll get, let me, one second, let me open Excel. Understand this concept so that it's very important for you to understand about options. 24,550. I'm buying a call option. This is of Nifty 50. Okay. I'm buying a call option. And the premium they said is how much? What is the premium? I'm not seeing. Premium was 223 rupees. 223 rupees. When is the expiry? Expiry is on Thursday. Okay. Nifty 50, 24,550. This is a strike. This is the price I'm paying. Becomes a strike price. 24,550 C of Nifty, 223 rupees premium I'm paying. That means what I'm expecting Thursday is the expiry. Remember, this Thursday is expiry. That means Nifty should cross 24,550 plus 223. That means if I have to be break even, just to break even, the Nifty should touch 24,773 by Thursday. By Thursday, if Nifty doesn't touch 24,773, all the premium what I paid becomes 0. The same way like when you buy a car insurance for 1 year, your car worth is 12 lakhs, but you're paying a premium of 15,000. You haven't met with any accident. What happens? All the premium what you paid 15,000 becomes 0. Next year again you have to buy. There's a time period of 1 year. Here there is a time period of just 5 days. Okay, from Friday to Thursday. Remember that.
So when I'm buying a call on say 24,550, Matthew, Nifty crossing 24,550 is not enough for me to make profit.
But this is on Thursday. I'm coming there. Yeah, this is a Thursday. So what happens? You bought it on a Friday. Okay, remember this. Bought it on a Friday. Nifty is here at 24,550 and you bought the strike price 24,550 by paying a premium of 223. Okay. Friday. After 2 hours, Nifty from 550 went to 24,750. How many points Nifty went up? 200 points. So 223 plus, I think premium will be 50%. So 100. Example, I'm just telling you. So Nifty will be your strike price, whatever you bought the premium, 223 will jump to 323. You made a profit in 1 hour, you made a profit of 100. So if you have taken a quantity of 25 into 323. So this is a profit you have made. How much you paid for buying it? 25 into 23. So this is, what's the difference? This minus this. 1,500 rupees you made profit. Again, what will happen? There's a possibility after 2 hours, Nifty might have again come down to 24,000 or 24,200. Market doesn't keep on going up, right? Keeps going down, up, keep going down and up. Whenever the market keeps going up and down, the premium starts melting. Remember that. I'll tell you, it's there in the slides. I'll explain you what that is called. The theta, that is called theta. It keeps expiring. Okay. So you need to understand this. There is a 5 days of time period for a weekly option. When you buy a strike price of 24,550 call for a 223 rupees premium, it's price is nothing but a premium you're paying. If Nifty doesn't go beyond 24,773, you are expecting, why you're buying a call at the first place? You're buying a call at the first place because you expect market to go up. That's the whole purpose. And why are you buying this strike price? Because you're buying thinking that this is a price, strike price, which is close to the, that is called in the money. I'll explain what is that, or at the money. Okay, that's easily bought it. You're paying a high premium for that. By the time within 6 days, 5 days, it has to touch 24,773 for you to be break even. Break even, remember, that means neither profit nor loss. If Nifty would have crossed on Friday 25,000, then you'll make a good, very good profit. 600 points, right? Almost. Sorry, 300 points. So 300 points proportionally, you'll get a very good profit for the money what you have invested. On the contrary, if you're buying a 24,550 put a P for a premium of 240 rupees. Okay, you're paying 240 rupees premium. In the same way, after 1 week, you're expecting Nifty to be where 240 this plus your premium. Sorry, not plus. It is put, no, so it has to be minus 24,550 minus 240. Nifty goes 24,310, you'll make a zero profit. Means you're at break even. If it goes below this, less than 24,310, that is when the profit kicks in for a put buyer. So not necessary that you have to wait till Thursday. You bought it on a Friday put. After 2 hours, from 24,550, it went down to 24,350. 200 points less. Same way, you'll make a profit of 100 rupees or 120 rupees. You'll make a profit within 1 hour or within 1 day. It could be next day. It went 200 points down. You held on with it. It went down. So you'll make a profit. Why? Because when you buy a put, you're expecting the market to fall. It has to fall. There's a premium you need to pay. This premium.
So Matthew, one question here. So this
Uh,
premium is dynamic, right? So say on Friday, I
yes,
am
yes.
buying it for 240.
Correct.
Say on Monday, someone else is buying the same at 300.
No, not 300. How the dynamic means, depending upon if the put has further fell down. For example, at 200. Okay, remember.
So for the simplicity, let's take the call, Matthew. That is easier, like because we are,
Okay. For
yeah,
call.
it is
Okay.
buying and buying easier, right? So
Okay, fine. So buying here, I'll put 24,550. You bought it at 223. Market within 1 day, next day went up to 24,600. The premium increased by 50 for easy calculation. So 223 plus 50. Tomorrow, if you want to buy this, you have to pay 273 rupees as a premium.
but again, I'm only buying 24,550 call, not 24,600 call, right?
Yeah, 24,550. This one only
Yeah.
will increase. This 550 will become 273 because this is a premium has increased, and
Correct, correct.
24,600 at that point would have been okay. Let's go with that also. Wait, I'll show you 24,600, right? That is also there. Wait, I'll
So
show you.
basically, my question, underlying question is this, Matthew: the different ways people like buying the same option for same strike price at different prices may end up like some of them who bought it at a cheaper price making a gain at expiry, and few people making a loss at expiry because of the premium
Yes,
at which they bought it.
correct. Yes, it's a zero sum game. Yes. So we bought it at 24,550. We paid at 223. Next day Nifty went by 50. So same strike price will increase by 273. That time it will be 273. I'll
So
give you a
if
small
at the
example.
expiry, if at expiry it ends at somewhere like we wanted it to be at 24,773, say it ends at 24,800. The first buyer makes a profit, but the second buyer makes a loss. Is that correct?
Yeah, but forget about second buyer, third buyer. You think about yourself.
Yes, yes. So yeah, if I was on
Yeah.
if I bought on the first day, I made a profit, but if I bought on the second day, I make a loss.
Not second day. Second day.
In
Okay.
our example,
How do you
in
know
our
that
example,
second day market is going up? You can't.
no, that's what in our example, the example that we
Yes,
took.
yes, yes. Yeah. If market went up second day, so if you bought it on the first day, sold it on the second day, or kept it, you had it, you're not sold 273, you're still at profit. Simple as that. As when you buy a call option, simplest thing you have to keep in mind, the market has to go up. You have to, whenever you buy a strike price, let me delete all this because you're getting confused. When you buy a call option, 24,550 C at 223, remember that by Thursday, if Nifty doesn't go this much to 24,773, you will not make a single penny. Your premium will erode and it'll become zero. So you have 5 days time. If you think within this 5 days Nifty will go 20 surpass 24,773, touch 25,000 or 26 whatever, then you end up buying a call option. Why you're buying a call? Simple strategy, because you expect market to go up. Or you think today let me buy, or today by end of the day before market closes, I'm expecting Nifty or Bank Nifty to go up. Still, you can go and buy a call option. This option, just imagine, might have went and touched 24,800. So you'll end up making 350 points growth. So you'll make up like 200 points gain. So 200 more plus 200. It will be 223 plus 200. This will be a profit. When it touches to 24,800 strike price, this strike price cost from 223 will move to 423. 24,550 CE price from 223, it will jump to 423. Clear?
And the strike prices are like, I have it close to the current trading price of Nifty 50. I have it on the both sides, up as well as down, right?
Sorry, can you say that again?
So say the current price of Nifty 50 or current index of Nifty 50 is currently at 24,400 something. And the strike prices available, if the strike prices which are available for me to buy the options are on both the sides, like 24,500, 24,500.
Yeah, you have, yes, yes,
And
yes.
I also have 24,000, 24,100, all of them, right?
Yeah, 24,550, 24,550, 400, 450. You have a lot of strike prices. I'll come to that. I'll explain you because the PPT I'm going through, right? I'll explain you. There are other things which you have to keep in mind. I'll tell you, okay? So
Sure.
the strike price, because I want to explain you about a strike price. That's the reason I've, because that is important for you to understand that. Wait, where's my?
Sure. Yeah. Some of my questions could be
Yeah, no problem. That's
disrupting
fine.
your flow, and it may be coming in the future, but I
Yeah, it
just
will, it will, it will.
need to
Sure.
ask them whenever they come to me.
Yeah, yeah. So strike price, I've shown you the premium, what you're paying. Expiration date, I've told you 1 week. Stocks 1 month. Even indices also 1 month. Call options. Buying a call option gives the investor the right to buy the underlying asset at the strike price. Whatever strike price could be 24,500, 24,600 in bank, Nifty 52,500, whatever. Okay. And you can buy a call option or you can buy a put option. Buying a put option gives the investor the right to sell the underlying asset at the strike price. What are the advantages of buying options? Limited risk. Whatever premium you paid, that is it. For example, you have taken insurance for a car. So maximum amount what you can lose if, for example, in that 1 year, you have not claimed anything on your car, you have not met with an accident. The premium what you pay 10,000 or 15,000 for your car, that premium is the only loss you'll have, right? So limited risk. Premium, whatever premium paid, that's the risk. Potential for high returns if underlying asset moves significantly. Yeah, whatever asset you bought, call options you bought, the underlying asset went up, you'll make profit. For example, you bought a put option, the underlying asset kept on falling down, you make a profit. Good profit with a small capital. Remember that. Risk is limited and the advantage or the gaining is unlimited. Profit is unlimited in options. Okay. They've given an example called, okay, at a strike price of 100 for a premium of 5 rupees. If the stock rises to 120, the profit is 20 per share minus the premium, 15 rupees. Simple, what I've told you in the same way. But what most of people, what they don't tell you is you pay a premium for an underlying derivative. For example, Nifty. Within 5 days, if it doesn't cross, even if it's at that strike price of 24,550, same where it was, all your premium will erode. It will become zero. That is, you have to keep in mind. So you have to buy a call option or a put option only when there is a momentum. Momentum means quickly the market is going towards either side. Quickly the market is going upwards or quickly the market is going downwards. That's when you have to buy. Remember the word buy, B-U-Y. Buy a call option or a put option only when there is a momentum in the market. When it comes suddenly, some news is there or some good news, some profit came, whatever profit in the company, there'll be a nice spike in the underlying asset. That's when you have to buy a call or a put option. Okay, option. I'm coming to option selling now. When I'll compare option selling with the insurance company. Insurance company, what they say, see, you have a 15 lakh or 20 lakh worth car. You just pay only 20,000 insurance. God forbid, whatever happens to your car, in that 1 year, we will take care. We will give you 100% coverage. Means total damage value 20 lakhs. We'll give it if you take a 20 24,000 premium, bumper to bumper, nil dip. Okay. When you hear that, you're thinking, okay, companies, do they make profit? Because a lot of he paying only 20,000 rupees, but a 20 lakh car meets an accident, they may be ending up making losses, right? But insurance companies are making profit, maximum profit, because out of 100 people who take, only one person or 2% will meet with an accident, and the percentage is very less. 99% people are ending up paying premium, but not meeting with an accident. Only when they meet with an accident, they have to pay, right? So option selling is like the insurance company selling, option selling. Option buying is like an individual like us who are paying the premium. So option selling people are collecting the premium from us. So call option, selling a call option obliges the seller to sell the underlying asset at the strike price if exercised. Put option, selling put option. But here remember, when I sell a put, I'm expecting market to go up. I am expecting market to go up. When I sell a call, I'm expecting the market to go down. Here there is a small catch. Remember this funda when I'm telling you, okay? See this. I've told you about call buying. Okay, now comes call selling and put selling. Call selling. Let's imagine 24,450. What was the price? 223, right? And here it was 24,550. I think it was 230 if I'm not. Anyway, we'll take some. Okay, so this person is selling. Nifty, if this call seller, remember what I'm saying, if this call seller has to make a loss, Nifty has to cross 24,673 by expiry, cross, go beyond 673. Then only call selling person makes a loss. So by this is on a Thursday. Thursday is the expiry, okay? Call seller will only make loss by Thursday if Nifty crosses 24,673. Why? Because he collected premium of 223 from us, from a buyer. And the buyer is expecting it will cross 24,673. But call seller is saying no. Nifty will 100% will not go beyond 24,673. That's the reason he's selling at this premium. If even Nifty comes 24,672 by Thursday expiry, call seller will take away all this 223 premium from you. Remember that. He will take entire premium what you paid from you. He will make money. On the contrary, if Nifty goes to 24,800, definitely call seller will make a loss. Here he'll make some loss. That's the reason call sellers liability is unlimited. Means sometimes what happens, Nifty may touch 25,000. It can even go to 26,000, correct? So his liability is unlimited. He'll make a huge loss. But for a buyer, the loss is limited to his premium, what he's paying. He's paid a 223. That's it. It doesn't go -1, -2. No. For a call seller, he will make profit. But the only thing, if it crosses beyond this, beyond the premium what he collected, it goes beyond that, he will has to bear a huge loss. This is a disadvantage for a call seller. In the same way, put selling also same way. Put selling. Put selling means what will happen. He's oh sorry, call selling. No, my mistake here. 1 second. Sorry. Apologies. Call selling means you actually market expecting to go down. So nobody pointed that out. See? Yeah. So call selling means expecting market to go down. So I have to minus the premium, right? So 224,450 minus 220. So the seller is expecting Nifty will not go up beyond 24,450, and the maximum premium what is collected is 24,227. सही करेक्ट ही बोला था पहले, सॉरी. All seller means I'm expecting the market to go down. The buyer will make profit, he's selling it. The seller will make the profit only when when the market goes beyond 24,673. Okay, buyer will make profit only when it goes beyond 24,673. If it crosses 24,673, then who makes profit? The buyer makes a profit because call buy kiya hai, he's expecting the market to go beyond 24,673. He makes profit. For put selling means nothing but I'm expecting the market to go up, right? But a buyer, what is expecting? Put buyer is expecting market to go down. So 24,550 minus 430. Okay. The put seller has got a cushion till how much? 24,320. That means by expiry, if Nifty doesn't go beyond 24,320, the put seller is making a profit. Why? Because he will be eating up all this premium. For a buyer, the premium should go less than 24,320 because he bought put expecting Nifty to fall down, but it has to fall down beyond 24,320 on the day of expiry. Only expiry day, if it comes 320, buyer makes zero, buy even. It's a break even. For put seller, he's getting all this 230 rupees premium is collecting because Nifty stayed where till 24,320 by expiry. This is how, what is the difference between a call seller versus a call buyer, a put seller versus a put buyer. Put buyer has got a limited liability. His liability is limited to the premium what is paying. But for a put seller, liability is unlimited. For example, instead of 24,320, Nifty closed at 24,000. He'll be making huge loss. So put guy will be making huge loss. All right. Got it? Have you understood this concept? You want it with you want me to show it in a real scenario, real time scenario?
Yes, please.
I think it's little overwhelming. I can understand for a beginner. Understand that. So let's do this. Let me open the basket now. 24,550 Nifty call option I bought. How much? 223. Let's put 23. Okay. So 25 quantity I bought it for 223. So total amount what I'm paying is 5,575. Remember this. So today is what? Monday. Okay, this is showing a Monday. Look at here. This is Monday. Monday 24,550. If Nifty goes from 24,530 to 24,653, end of the day, still I'm in loss, minus 23. On Tuesday, 24,776. I'm making a profit of 1357. But what happens? Look at here, 24,773. Look at my Excel sheet. 24,000. Wait, where is it? Premium is 223. No, 550, 650, 773. सही है ना? तो इधर calculation गड़बड़ हो गया. Sorry. Plus no. 20. Oh, this is 550 actually. It took 550. Let me change it to 550 so that you'll understand it better. Okay. So 24,550 plus 223, 24,773. See this? If I attain 24,773, break even बोल रहा है. मतलब I will end up being no profit, no loss. So what I'll do, 24,773, I will put it on a Tuesday. Still you have made a profit because it's a Tuesday. What happens Wednesday? Still I'm profit 568. Thursday 0. See this here? Just because Thursday is the expiry date. I made the break even 0. Let me go back. If Monday 24,773 आ गया, I'm making a profit of 1,933. Simple, very straightforward, nothing. You bought a call option expecting the market to go up. So let me reset this. Right now, Nifty is at 24,530. If by Monday, if it increases by 0.5%, that is 24,653, still you're ending up minus 23. How much it should have been if it would have been like, yeah, 24,776 or 24,750. You're making some profit. This is for buying. OK, remember that. And unlimited. For example, on Monday, Nifty went like 3% up. You're making 14,000. It can go up till 6%, maybe because of budget. Very positive vibe. Market went 6% up. You'll end up making 33,000. Just over a 5,000 rupees you spent, you made 33,000. For 5,000, you get 5,000 rupees profit. That is 100%. For 5,000, you make 500 rupees. It is like 10%. 10% in a day is very huge. Remember that. So I'm just telling you. That's how you. So for call, that is how you calculate. I was talking about call selling, right? I'll tell you why. And remember, here your loss is limited to your premium for buying. Look at this projected loss. On Thursday, market goes down. I'm talking about because we're buying. Itna bhi niche jaane do. Minus 7.5% or minus 10%. Your loss is only 5,575. That means the total premium what you paid for buying that strike, that's a loss. That's it. It doesn't go beyond that. It's limited. आपने 5,000 लगाया, see 5,575. That's the total loss you can get by Thursday. It cannot go beyond that. On the contrary, you sold a call. Sold a call. 223 rupees. You collected the premium like an insurance company. You collected the premium from a buyer. How much you're ending up paying? 69,000. For a buyer, how much is only 5,000? Like a insurance company car met with an accident, you have company has to pay the entire amount for that fellow. Get your car repaired or okay, we'll buy a new car. For the buyer who is buying the car insurance, he's paying a normal amount. So here he's paying the premium 223 for 25 quantity 5575. But for a seller, 69,000. Okay, I modified it 69,000. Let's look at the graph. Look at the graph and look at the profit also. Okay, today is Monday. Nifty stayed wherever it is, 24,530 on a Monday end of the day. Call seller is made a profit of 1,6089. Next day, Tuesday, market went up by 0.5%. Still, call seller is making a profit of 751. Either देखो break even. Why? Because his break even is 24,773. By Thursday, Only when Nifty crosses 24,773, this person who sold the call option, he will have a little fear. Next, okay, let's go to Wednesday. Market went by another 0.5%. He is making only a marginal loss of 634 rupees because 773 is the break even. Here it went up to 776. Now look at the headache of a seller. What happens when I told you unlimited loss? On a Thursday, Nifty went up by, because of the budget, whatever, went up by 9%. He's ending up paying 49,000 loss. If it goes further up, 76,000. Loss is unlimited for a seller. But seller makes money. Like an insurance company makes most of the time money. The buyer ends up losing money most of the time. In the same way, seller, most of the times they make money because they're collecting premium. But unforeseen circumstances, budget aa gaya, but went exactly opposite to what we thought. COVID situation, 2008 Great Recession, Harshad Mehta scam, ऐसा कुछ, something happens of that sort, and unpredictable happens. You are a seller, for example, you are a seller, you are at market is at 24,007, still at 20. Let's put it like this. Sorry. 24,530. No? Yeah, 24,680. There's only one more day. Your break even is at 24,730. Another 100, approximately 100 points. You're expecting no, market will not go 100 points next day because it's a Friday. I don't, sorry, it's a Thursday. I don't think, but suddenly some bad news comes. What will happen? Market will go by another 5 or 6% up. That's when huge losses comes. Maybe COVID situation or whatever. That's when the sellers make a huge loss. Is it clear? That's the difference between a call seller and a call buyer. In the same way, if I buy a put, okay, let me buy a show a put, 24,550 PE. I'm buying. Okay, I bought it at 240 rupees. So let's look at the graph for a put. This is a graph for a put. Put me. Why did I buy a put? I'm expecting the market to go down. What is the break even now? 24,550. Nifty is at 24,530. I bought a strike of 24,550. PE 240. If I have to make a break even by expiry, Nifty should touch 24,310. That means why 310? 550 minus this 240, that is coming to 24,310. So let's see. So Tuesday market went 0.5% down. Wednesday market went 0.5% down. Thursday market again went 0.5% down. 3 days continuously market went down 0.5, 0.5, 0.5. I make a profit of 3,674. What is my capital I paid for buying a put? 6,000 rupees. What is the profit I gained? Okay, reset. Okay, 0.5, 0.5, yeah, 1.5. I'm making a profit of 9,000 rupees. It was initially 6,000 rupees. No? Why? Because I went till 3 days, Wednesday. Okay. Yeah. $3,674. This is the profit I'm making. But what happens on the contrary? Let me reset this. First, on Monday, market went 0.5% down. Let me show it on a Monday. This is Monday. 0.5% down ho gaya. You're gaining a 1 rupee 35 paisa. 1 rupee 35, 135 rupees. Next day, what happens? Tuesday, market went up by 1% or 0.5% went up, nullified. You're ending up in loss 2,000. Wednesday, market again went 0.5% negative. You're still at loss. On Thursday, market again went by 0.5, 1%. You're making a 608 rupees because market cannot keep on going up or down, right? It can fluctuate up and down. This is how you calculate the premium. So you're making a profit of 608. Why? Because what is your break even here? 24,310. If the market goes below 24,310 by Thursday, only then you'll make a profit. But that doesn't mean that you'll not make a profit on the first day. You can make profit on the first day. How? On a Monday, market opened. Okay, market opened and fell by 1%. Assume you're making a 2,237 rupees. It could be within 1 hour, market can go 1%, or 2 hours or 3 hours. Market went down. So you made already 2,237. You think, okay, it is just 50% returns I got on my capital, almost 50%. You can square off the position. You can how you square off a position? Because you bought this put, you have to sell it and close it. Simple. Or if you have sold it first, you have sold it, call seller. Then what you have to do? You have to buy this and square off your position. Simple. How you can look at the graph? Let me open the graph also so that you understand. I've shown you about the graph. This is how you have to check. For example, if you buy a 24,550 C call, look at the graph. You can put a 15 minutes, and this also you can see. See, from here, from 223, it went up to 412 rupees, 100%. On the same day, it went up from 200 and some 18, 20 rupees to 410 rupees. You could have sold at 361. You could have sold at 328. You can sell it. I'm looking at a 15 minutes candle. Okay. In the same way, let me put it for put. Put also I'll show you. Put is even better because see this from here 122 went all the up till 259. I'm talking about the same day, 19th of July. From 125 went up to 259 and stayed at 245. Where you can get 100% gain. You bought a put, you got 100%, means 6,000 rupees you spent, you got 6,000 rupees profit, which is 100%. Bank deposit 6.5% or 6% you get in a year. Here you're getting 100%. You don't get every time, but I'm just telling you. For a seller, just imagine what would have happened. Somebody might have sold a put at this strike price, went up. He's not under fear because he might have sold, how much he might have sold for 240 rupees premium. So this is only 120. He still has 120 up to go for him. He will not panic. He will only panic when it crosses his premium and the MTM starts showing a loss. Here, any doubt? Ask me, please. I'll further explain you so that you'll understand. I know it will be a little overwhelming for you at this point of time, but as I explain you a little slowly further, it'll become easy for you. So I've told you limited risk for a buyer, unlimited risk for a seller. Remember that. So advantage, earn premium income upfront. Yes, you're collecting the premium upfront from the customer. When you take a car insurance, you don't pay at the end of the year. You pay at the beginning itself. He collects it, right? And the probability of making profit for an option seller is high. The probability of making profit for an option buyer is less. However, limited liability for a buyer, unlimited liability for a seller. Any questions? Please ask me. If you have any questions, please ask. They're very basic. If you don't understand this, it will be difficult for you for you to participate. So can I continue? All right. Risk comparison, I already told you. Option buying and option selling. Risk is limited to the premium paid. Potential for loss of premium if the option expires worthless. Risk can be significant or unlimited for naked calls. Somebody is asking about naked calls. Naked calls means you're not hedging the call and you'll make unlimited loss. Okay. And if you are sold a derivative of stock, must fulfill the obligation to buy or sell the underlying asset if the option is exercised. At the expiry, you sold a Wipro um, call option. Okay. That means if you don't square it off before the expiry, you're obliged to give those many shares to the buyer who is buying. So that is careful when you exercise something to do with stocks. Indices, you don't have a problem like that, but with stocks, you have it. Let me go and show him. Okay. If you have understood this, then I'll go to explaining about how one can place the order so that. Okay, let me show you here. Somebody is asking about naked calls, right? See, this is a naked call. For example, I'll take a bigger number so that maximum quantity in a Nifty is 1800. I have to pay 49 lakhs. How much profit I'll make by Thursday? If the premium, whatever I collected 223 within that range, I make a profit of 4 lakhs rupees. If Nifty doesn't cross 24,773, I make a profit of 4 lakhs rupees. This is a naked call, but the naked call disadvantage is what happens by, look at this one, by Thursday, Nifty goes up by 6 or 7% or whatever, some percent up beyond. Nifty went up by 9%. My loss is 37 lakhs rupees, my loss. Unlimited. Nifty went by some great news. I'm just telling you, it doesn't happen. Went up by 12%, 50 lakhs rupees loss. 50 lakhs. What is the premium I paid? 45. It's gone beyond my premium. It can go even further. In the same way, what I can do, I'm expecting Nifty will not cross 24,800. Okay, or 24,773. I can, instead of naked call, what I will do, I'll hedge the call. How I'll hedge? I'll buy 24,650, 100 strike price above the current strike price. What I will do, I will buy it. How much? Same number of quantity, 800 quantity I will buy. Okay. From 52 lakhs, now the premium went down to 13 lakhs because I hedged it. So what I did, 24,550. I'm collecting how much premium? 223 rupees premium I'm collecting. By buying, what I'm doing, I'm paying them a premium of 176. But 223, 176. So 223, 176. See this. 223, I'm collecting the premium from some X fellow. This is what I'm paying because I also bought a call option, right? I have to hedge. Hedging is nothing but you're trying to control your losses. So what is the total premium I've collected? Overall premium 223 minus 176, 47 rupees premium I'm collecting by hedging. So that's what I've did it here. You can also take 200 strike price, but your loss may increase. So look at now the graph. Probability at expiry 24,500. So 25,000, 24,600 has come down. But what is the advantage I get here? Look at my maximum loss cannot go beyond 95,000. My maximum profit is 84,000. how this I derived by hedging my position. Why did I hedge? I hedged because God forbid I'm expecting the market to fall down. God forbid market has not fallen down. It went up against the call what I took. Then it will safeguard me. And my losses are limited to only 95,000. What is the probability of profit? 55%. 55% is the profit. Just let me take off this hedge. Maximum loss, it says unlimited. Probability is increased by how much? From 55 to 69. It increased by another, how much? 14%. Correct? Yeah, 55. Okay. 55. Take off this 69 means 14% probability increased, but loss is unlimited. This is too scary for me. What I did, I put a hedge. By putting a hedge, my probability decreased a little bit, but my profit also decreased because I put a hedge. This is how you can hedge your. So this is going against the naked call. Without hedging, it's called naked call. With hedging, this you are protecting. What you can do, if you're dead sure that Nifty will go down, it will not go up because of some very bad news. Instead of 100 rupee strike price above, you can buy 24,650 call option because you're 100% sure some bad news has come, it will not go up. I think I took 750. Let me take 200 points away. 24,750. 136 rupees premium. I'm paying. Here my margin increased. Let me analyze this. All right, see this. Probability of profit is 59%. From 55, it increased to 59. Maximum profit 1.56 loss gain, and loss is 2 lakhs. Why? Because I increased the hedge position 200 points away. This is another thing. If you're 100% sure Nifty will go, or not even 180% sure that will go, then you'll take this call because your losses are limited. If I take off this hedge, losses are unlimited. If I put the hedge, losses are limited. This is one thing you can do. One more thing, what strategies they do is, for example, Nifty is at 24,530. Person like me, just imagine, I'm thinking tomorrow market will fall. So today on a Friday, I would go and take 24,450. I will sell it. 100 points below. Remember, that's called in the money. And I will hedge it 24,550. .47 probability, but I'm sure the market will fall down. I'm making close to 1 lakh rupees. Loss is 81,000, which is fair enough, less than the profit I make. This is how I took. And look at the graph. The more the Nifty goes down, I keep on making profit. Simple. In the same way, you buy a put also. You sell a put. Let me 24,550. You sell a put. When you sell a put, you're expecting market to go up. Okay. So maximum profit, see, maximum loss is unlimited because it's a naked call. What is your break even? 24,310 by Thursday. By Thursday, 24,310. If it reaches by end of the day, you're at even Steven. You're not making any profit, you're not making loss. But if it goes beyond 310, the loss starts kicking in. See, keeps on going up. So that's the easy calculation. What do you do? Whenever you buy any strike price for call or put, add that number, the amount premium what you're paying with the strike price. That means Nifty has to go till there. When? Till at the end of expiry. For example, I will tell you Monday there is expiry for Bank X. Okay. What is a Bank X now strike price? 60,167. This current. There's something called at the money. Okay. What is at the money? For example, Nifty is at 24,550. Right now it is 24,550. The strike price of Nifty as on today now is 24,550. That is nothing but at the money. 24,550 is at the money. In the money means for a call option, this is for call, okay? For call and this is for put. In the money means 24,500 or 24,450 or 24,400. This is in the money. Anything inside 24,550 inside is in the money. Remember that. At the money means whatever the strike price is at that point of time, you round figure it. For example, if it's like 24,530, we'll put it 24,550 or 500. So we took a strike price of 24,550 at this point of time. At the money, 24,550. When they say in the money means anything inside 24,550, like 24,500, 24,450, 24,400, 24,350. It's called deep in the money. If you go a little deep, so in the money. What is out of the money? Out of the money is anything above 24,550, like 24,600 or 24,650 or 24,700. This is called out of the money. Remember, strike price, whatever strike price current holding the market now, when you looked at the Nifty 50, it's 24,350 because you don't have a strike price for 24,355, sorry, 530. So you're putting it as 550. At the money, 24,550. In the money, anything inside 24,550. It's called in the money. So if you want to go, what you can do, go to open a Chrome or whatever, write NSE option chain, enter. First thing which comes up, click on that. Okay. This is an option chain you'll see. Okay. Drag it down. You have a color change here, white and little, color change. Here also you have left side is calls, right side is put. See this calls, this is put. But these calls are not call buyers. Remember, this put are not put buyers. The call writers and put writers. So if see 24,550, this is at the money. Anything inside 24,500, 24,550, 400, 350 is called In the money. That's the reason they put it a color in the money, different color. Anything beyond 550, 600, 650, 700, all this called out of the money. And at the money is 24,550. That's what I've shown you in the Excel sheet. In the same way for put 24,550 is at the money. Okay. Put means what? Put means market we expecting it to go down. Call means expecting market to go up. So put 24,550. What is in the money? In the money means 24,500. 24,550. 24,000. Sorry, not 5. 24,450. 24,400. This is in the money. Anything in the money. So 24,500. At the money for put is 24,550. 24,600. 24,650. 24,700. This is for put. Put in the money means anything above the strike price. For call in the money is anything below the strike price. For put, anything above the strike price is in the money. Out of the money is anything below that. That means 24,500, 24,450, 24,400. This is out of the money. Remember, for put, anything above the strike price is in the money. Anything below the strike price is out of the money. For call options, anything inside the below the call option is in the money. Inside 24,550 is in the money. Anything beyond 24,550 is out of the money. Simple as that. In the same way, if you look at this chart, also same. Look at put. 24,550. No, in the money is 24,600 in the money. 24,650 in the money. 7 all in the money. 24,500 out of the money because white color here. The in calls white is out of the money. In put here white is out of the money. All that is out of the money. Whatever strike price less than that input is out of the money. Whatever strike price less than that is inside the in the money for call options. You have to be knowing this. This is also very crucial when you select a strike price. If you have any doubt, please ask me now. This is little crucial because it tells you what strike price you have to buy looking at the current value of the market. If Nifty is 24,550, what if you want to buy a call, which strike price you have to buy a call? If is put, what strike price you have to buy a put? Very important because the premium what you pay for a call and the premium what you pay for a put, as the time goes by, there is a decay that is called theta. There's a theta decay is there. Slowly as the time keeps on going, there's a decay. That means as a time interval, like the car insurance I told you, every month your premium keeps on reducing little by little because the time value is reducing, right? Like that. Here, whatever premium you're paying, as on when every day, little by little, the premium will get eroded. So for the premium not to get eroded quickly, what people do, they buy, for example, if it's a call and the strike price is 24,550, they buy a strike which is 24,500. Buy because it is in the money. The premium eroding happens slowly. slowly compared to 24,500. Or for P, if I have to buy, if the strike price is 24,550, right now market is at 24,550. Put what I'll do, 24,600 I'll buy, because this is in the money. 24,500 is in the money. Here, premium erosion happens slowly. You can buy 24,400 also, but again, you will be end up paying high premium. So you have to take a calculative risk where you don't end up paying high premium, but also take a strike which erodes your premium slowly. Any questions, please ask.
So lower the theta, better it is. Can we say that?
No. Theta is nothing but the percentage of drop in the premium you have. Yeah, lower the theta, it's good for you. That's the
Okay.
reason you buy something which is at in the money. Theta is nothing but whatever premium you're paying, the percentage of premium, whether it goes up or going down, that is how the theta is calculated. So theta gets diminished on your premium as the time passes by. If you bought 24,550 and market is going towards your side, 24,600, 24,650, then what happens? The delta keeps increasing. That things which are very important: delta, gamma. I'll not get into depth. All this is very good. Whole 1-2 days will go in explaining this. Whatever premium you're paying, the premium erosion will happen depending upon theta. Theta calculates how much of the premium should be eroded or added to your premium. Delta is a percentage gain when your underlying asset increases. For example, you bought a stock, for example, Wipro, for 300. It went up to 350 stock price. So the delta determines how much increase should be on the premium. For example, you for 300, you paid a premium of 30 rupees. So now you'll go to 45 rupees. Example, this 15 rupees decided by the delta gain. Delta decides how much premium should be increased when the underlying asset goes up from 300 to 350. Theta determines the premium what you paid, what percentage erosion should happen, how much percentage it should be reduced if the stock price from 300 to 300 remains, example, on the same day it has not moved, kept there. What is the percentage of down from your premium should be eroded, taken off? That is theta. Gamma value is from 0 to 1. Gamma means the percentage of gain when the underlying asset increases depending upon your premium. Means gamma is always high where you are at the money. Whenever you're at the money, the gamma is 1. And gamma decreases from 1 to 0.5 to 0 when it goes out of from at the money to out of the money, or at the money to in the money. The gamma maximum is at the money. That's the reason you might have lot of people talking about gamma blast. You might have heard the word gamma blast. What happens suddenly at 3 o'clock, 3 p.m. or 2:45, a strike price, just imagine 24,450. Nifty is at that point of time. From here, Nifty jumps to 24,550. From 24,550 came down to 24,550. Immediately from 450 to 550 it jumped. So gamma shoots up because again went up to the ATM. This is the ATM price. Shoots up, the gamma kicks in. So your premium, like 5 rupees premium, increases to 15 rupees within a jiffy, within like 1-2 minutes, 3 minutes. Sometimes it can go up to 50. I've seen cases where it went up to 150. That is called gamma. Let's not touch all this because it's a little overwhelming for you guys. I hope this is clear with you. All selling, put selling. What strike price to buy, at the money, in the money, or out of the money. If you look at out of the money, I'll show you what is in the money, at the money, or out of the money with the chart. Okay. Now the market is at 24,530. So let's put it as 24,550 C. This is at the money. 24,500 C. This is inside in the money. And 24,600 CE. This is out of the money. Look at the price difference. 24,550 C, 24,500 C, and 24,600 C. 24,500 C is at the money. The at the money premium is at 223 rupees. Inside the money. Okay. 24,500, which is 248. Almost 25 rupees more. Why? Because it's inside the money. In the money. Okay. So what happens? A theta decay, what happens? The premium decay is little slower compared to at the money. Out of the money, you're only paying 200 because the theta decay is fast in out of the money. When you go out of the money, the theta decay is too fast. In the same way, 24,550, no strike price. So 550 put 24,600 put and 24,500. See this also the same way. You have to be familiar with this concept. Otherwise, when you buy options and play, you'll make loss. 550 is at the money. At the money, 240 rupees premium. In the money, I told you for put option, you have to buy which is above. 24,600 put is 268 rupees. That means 28 rupees premium. I have to pay more. Why? Because it's in the money. And 24,500, which is out of the money. I'm paying only 270 rupees premium. Out of the money, the theta, the decay of your premium happens quick. At the money, the decay happens little slower. In the money, it happens little more slower. Deep inside the money, it will happen very slow, but the premium will be too high. For example, if I have to buy 24,550, this is strike price. If I have to buy 24,000 C deep inside the money, look at the premium I have to pay. 592 rupees I have to pay. The good thing about this is the decay happens slowly, but premiums are too high, right? Too high. I'll not afford to buy this. I'll not buy. But good thing, decay happens slowly. That's the reason what we encourage people to buy inside the money. Call options when you want to buy inside the money. When you want to buy a put option inside the money. So let me ask you a question. If you are a seller, you want to sell an option, which one you should buy inside the money, outside the money, or deep inside the money? Please tell me. For a buyer, at the money or inside the money is ideal. For a seller, which strike price? In the money, at the money, or out of the money? Which one should I buy?
I think out of the money.
Think. Okay. Any other answers from other folks? There are no correct answers. I told you. You can ask questions. You can tell answers. No problem. You're learning. So you try until at least I'll understand that you understand the concept. What do you think? The seller, which he should sell in the money, at the money, or out of the money to be safe? I'll explain you. For a seller, see, for a buyer, if a buyer buying in the money, at the money is useful, then for a seller point, for him, it should be out of the money. So what I will do as a seller, if Nifty is at 24,530, what I have to do as a seller, I'll tell you. 24,550, no, 300 points, or how many? Monday, Tuesday, Wednesday, Thursday, 4 days, no, 400. 700, 24,800 out of the money I'll sell. I'll sell 1,800 quantity. What I'll do, this far out of the money, okay? And 24,900, I will hedge it. Market is at 550. I'm buying 800 call. Let's analyze this. 74% probability of me winning is there. How much profit I'll make? 56,000. Maximum loss is minus 1.24. Loss I'll make is 1.24 lakhs. I bought far out of the money. Okay. This is trying to lessen your risk. For a seller, the more close you buy to the ATM, your risk is high. Until unless you're 100% sure the market is going to fall from here, then you can buy the ATM. As a seller, always buy out of the money. As a buyer, always try to buy at the money or in the money so that your premiums don't get eroded fast. For a seller, the premium has to get eroded fast. Only then he or she makes money. So in this way, so now you have 74% profit you have. Same thing. If I'm buying 24,900 C, my probability of winning, making profits of 16% because I bought far out of the money option. Far out of the money, 16% only I have an option. Right? And if it has to go, how much percentage it has to go? 990, no? 2% Nifty has to go up by Thursday. Only then I will make a profit. A buyer I'm talking about. But seller break even is at 24,831. He starts making loss only when Nifty goes beyond 24,831 by Thursday. Even before that, for example, if on Tuesday, if it crosses 24,890, 830, still will be making loss, but they'll keep on holding it. They have a chance of holding it because next day Nifty may gap down or decrease. They may end up making a profit. Expectations. Okay. So as a buyer, always make sure that you buy in the money or at the money. As a seller, it is for good for you if you sell it out of the money. Clear? Let me know if you have any questions, please. That concept is very important. If you don't understand that, then you'll make mistakes. Okay. I'll tell you a couple of strategies which you can use it for option selling or option buying. Still, I'm asking you if you have any questions, please let me know. 80% of the time or 85% of the time, remember market is always sideways. Only 50 to 20% time market goes haywire, very extreme case it goes up and goes down. The best strategy, what you can do is, for example, Nifty is at 24,550, right? So what we will do, there, right? $24,550 Nifty is at. What you can do, 5 days, 5 days, Friday, Monday, Tuesday, Wednesday, Thursday, right? 5 days. So Nifty goes even 100 points into 500 points on the upside, 500 points on the downside. Okay. So what do you have to do? So 24,550 plus 500 here, 24,550 minus 500. So 24,000, 25,000. Round figure will put 25,000. We'll put 24,000 here for a call and a buy. Okay. How I calculated 100 points every day Nifty going up. Highly impossible that for 5 days keeps on going up, right? It doesn't happen. But to be on a safer side, what I did 100 for 5 days, 500 points. I added to this strike price. For a put means going down 500 points. I deducted. So 24,000 round figure, 25,000. So let's go to this builder. What I'll do 25,000 call. I'll sell. Then 24,000 I will sell. Okay. Now what I have to do, this is naked call. Naked call, what happens? Okay, I've shown you that also. 3,000 profit, but unlimited loss. Unlimited loss. Probability of profit. This is very important. Whenever you check, make sure that you have to check your probability. How much what is the probability? 81%. Fair enough. Good. But this loss is unlimited. So what I want to do, what I will do is I would hedge it. How I'll hedge it? 25,100 call and I bought 100 strike price above 25,000. So put what I have to do 100 less than 24,000. That is 23,900 put I will buy because I want to hedge it. Now I have hedged it. I've hedged it thoroughly. Premium what I'm paying 29,000 rupees premium what I'm paying. Okay. Profit what I'm making 845 rupees. Maximum loss 1,655. But the good thing is probability of profit is 73%. How I can reconfirm whether this 25,000 on the upside or 24,000 or 4,000 on the put side won't be breached? For that, I've shown you a tool which is called Sensible. Go to Sensible. Log into Sensible. It is free for most of the Demat accounts. Go to Open Interest. You can see how many people have bought all options. 69 people for 25,000 strike. Right now we are at 24,550 here. Sorry, here. Okay. I'm talking about 25,000, 64 lakh and 24,000 put. They don't have, that means they're not expecting even to go touch 24,000. That's how you can check it with Sensible whether you are safe or not. With the capital of how much you put initial capital 29,000. Okay. 1% is 295, 2% is 550. 2% is 550. 3% is 750. Example 750 rupees. 3%. 3% in a week. If you play like this, safe, without any headache, bought it and left it. 3% in a week. 4 weeks are there in a month. 12% in a month. In a year, 12 into 12, 144%. 144 छोड़ दो, बीच में कब loss आएगा शायद. Even if you make 80 to 100% in a year, don't you think it's an extraordinary gain you make it? Even though amount looks very small, but what percentage it is? 845 to be precise. 29,000, 30,000 pakad lo yaar. 30,000, okay. 30,000, 845. 845 divided by 2.8%, which is close to 3%. 2.81% into 4 weeks in a month, 11%. In a year, there are how many months? 12 months. 135%. Forget about 135. Even if I get 80%, I will be ecstatic, very happy. This is how most of the people make money if they have a good capital, because I put less number of quantity. Just imagine if I'm playing with 1800, number looks a little more better. As the capital increases, definitely the amount you make increases. And this is very safe. You're buying too far out of the money, 500 points out of the money you're buying, right? Far you're making like this. See, 60,000 in a week out of a capital of 20 lakhs. 60,000 into 4 is 2.4 lakhs. 6 4 is 24. 2.4 lakhs in a month. In 12 times kitna ho gaya? 2.4 lakhs into 12. 0.4 into 12. 28 lakhs, which is double your capital invested. This is how you have to put. This is one of the strategy. Simple, straight. What I've told you, whatever the strike price is nifty, 500 points up, 500 points down, sell a put, sell a call, hedge your position, keep quiet for 1 week. And you should also know when to jump. When you have to jump is Thursday by mid of the day. That means by 1:30, I would say 1. Before 1, if you jump, great, but don't cross beyond 1:30, because after 1:30, the gamma effect kicks in. So on a Thursday expiry day, before 1 o'clock, whatever is there, jump off slowly. Okay, that you can do. Another thing, what I can tell you, you can try this. This premium is whatever you're collecting, like 67, this will become like 1 rupee or 5 rupees, 3 rupees. This 47 rupees will become like 2 or 3 rupees. What you can do, you can sell this, both sell it off and square it off. Keep this just like that. After 1:30, what happens because of the gamma effect? Sometimes it's premium from 3 rupees may jump to 10 rupees. That time you can square it off. Rarely it happens, but whenever it happens, you can make some like 10, 15 rupees quick. That means you'll make like 1800 quantity into 10 rupees is 18,000. I used to do is, if this premiums get eroded like to 5 rupees or 3 rupees, I used to square off my sold positions and keep it. Sometimes option, because of gamma effect, the 3 rupees, 2 rupees options will jump to 15, 20, then you make a profit. Any questions?
I guess, Matthew, executing and understanding is a very different game. Needless to say, I think what you have done is you have brought us to a level where we understand what are our options, what can we do really with option trading, but how to execute and when to execute, with how much risk to take. I think that is how that is a call that we'll have to take based on what you have taught
yeah, I
us
was about to,
so far.
yeah, I was coming there. Yes, that is a very important stuff. What you can do, see, this is all about options. I've told you what you can buy, put, call, all the stuff. I've told you about in the money, out of the money, ATM, everything I told you. What happens is that, see, there's options itself is a big chapter. That's the reason I'm coming up with a course exclusively only options, different strategies, all the stuff covered in that. But I can share one small thing. What you can do, whichever strike price you're buying. Okay, for example, 24,550 market is there. Whichever strike price, open that graph chart. Okay, the trick, small trick I'm telling you, so that you can play on a Monday or Tuesday. Open the chart, go to a 1 hour, make it 1 hour. Look at this. Okay. Open this chart for 1 hour. Red candle, 1 hour chart I'm talking about. Red candle, after a green candle, then red candle. So what I did, I'll tell you. Normally, if I'm planning to buy a 25,550 put, I will see where is the base, where is the support for this premium. So I saw one red candle stopped at 123. Again, there is a red candle for 1 hour. There is a small. That means it is slowly making a base here. I will take a risk. How? I'll take a risk 24,550. I will buy. Example, I'm telling you. Okay, let me take a small quantity. 25 quantity. I'll put a stop loss of 10%, a gain of 50% or 100%, depending upon how much you want to take. My minimum risk is how much? Only 10%, means 240 rupees ka 10%. That is 24 into 25, 625, 623 something, 625 rupees my loss. But if I make a profit, I make around 3,000 rupees profit. 3,000, 50%. Exactly, that's what happened. From here, it went up, but it went up 100%. You take another strike, 24,550 C. I'm talking about 1 hour candle. Okay. Look at here. 1, 2, 3, 4. How many base it made? It was not going beyond 155. It was holding on to 155. That means big money, smart money people doesn't want this premium to go below this. Otherwise, it easily could have hit, no? So what do you do when it touching? Whenever you see a candle pattern, like it made it made a morning star. Let me show you. Big red candle followed by a doji, then a green candle. What I will do, I will take my call here at 163. I'll make it went up to how much you could have sold here, could have sold here, you could have sold here. Depending upon your risk factor, you can keep it. That's how I decide when I buy a premium, any strike, a put option or a call option. This is one of the strategy which I follow when I buy a strike price. Don't just blindly because Nifty is going up. Okay, let me buy this. No. Immediately Nifty, what strike price or bank Nifty, whatever strike price for example, bank X Monday. See this 1 hour chart I'm talking about. 1, 2, 3 candles here. That means it made a good base. So you'll draw something like this base. After that, go to a 30 minutes candle. Shift it to a 15 minutes candle. Shift it to 5 minutes. See, 5 minutes candle, how many times it took base? Several times took base. That means big money doesn't want the premium to go below this. That means they're expecting pull the market a little on the higher side. That's how you analyze a strike price of 60,200 PE. Even if it was from how much 147, you're not bought. Okay, even if I would have entered somewhere here. At what price? 166. It went up to or here 252. Fair enough. I made like cool how much? 80 rupees I made. More than enough, no? This is how you have to analyze. Not only this, there are a lot of other strategies. A lot of strategies are there in buying option and selling options. When you buy, keep in mind the seller's perspective. How does the seller think? When you're a seller, keep in mind how the buyer thinks. On that basis, you have to use your brains and play accordingly. You have any questions, please ask. I think I gave you one nice strategy now, no? How to buy a strike price?
Yes. Yep.
Yeah?
Yeah.
Yeah, now you can ask questions you can have. Please ask me any questions if you have. Which be questions you can ask. Related to options. And especially for an option buyer, you have to be technically smart guy. Technically too smart you have to be. If you're not technically smart, then for option seller you don't have to be technically smart, because you're buying, selling far out of the money, far out of the money you're selling. And somewhere I've written something here with this technical analysis you have to do. How? Like the way I've shown you. First, what you have to do, pick up whichever indices you want to put your money, take that graph, go to a 1 hour from one day chart. Look at how does a 1 day chart look like. You see any pattern here, like some doji, some morning star, evening star, or some Marubozo. I can see some big candle here. What do you call this red candle? What do you call this red candle? The daily time frame Nifty 50 red candle. Big red candle. What do you call it? आप लोग जल्दी भूल जाते हो और तొందరగా మర్చిపోతారు మీరు. This is a bearish engulfing, right? It is engulfed the preceding candle completely from top to bottom. Huge bearish engulfing candle on a daily time frame. So what does it suggest? Possibility is there. Monday, it can be a gap down for Nifty. That's how you can start your predictions. Then what you can do, then go to our hourly chart. Hourly chart, open it and see what is the maximum Nifty went here. 24,857. That day, where it ended here. There. Next from here, it went up. This is how you have to plot a chart. On an hourly time frame. From hourly time frame, move to 30 minutes. See where somewhere you get points. Yes. See here, from here market came down actually that time. So you can draw one more. That means this has become a support now. Initially it was a resistance, became support. Now it is a resistance like that. Again here. Then go to 15 minutes. See if you can connect any points here. Don't see. Okay, we already covered. So go to 5 minutes. Now you have almost got a range. How Nifty will behave. Then you have to decide if wherever the Nifty is, has it opened near the resistance? If it opens tomorrow, I'm just telling you, if it even the gap up but opens near 24,857 is a high resistance. If it gap down opens near 24,500, there's a support. But if hits the support, it comes down, it may fall down. Next support is at what 24,343 according to a chart. Is it correct? You have to check. Oh, here it is. Okay, so it is somewhere here 24,439. Like that, you have to draw a chart and find out. Based on that, you have to take a decision. If Nifty is coming near the support, be cautious because chances are there it can go up. Chances are there it can go down also, but chances so we have to be a little careful. Let it either go down with a confirmation candle or go up with a confirmation candle. It could be a morning star, or for going down, it could be an evening star. It could be an engulfing candle, anything it could be, right? Based on that, you have to take a call. And don't just buy what do you call like example, just don't buy some 25 quantity of call. Where is it? Yeah, 223 you bought it, 25 you put some 10% stop loss, you put some 50% and you said buy. Okay, sell किया क्या मैं minus Okay, buy. Okay, market were closed. I can't. All right. So what you have to do, you wait. Either it has to hit your stop loss or it has to hit your target. As soon as you see some 5 rupees, 10 rupees profit, no, don't jump off. That is a bad practice. You never become a long-term trader. You'll end up losing money. That is called impulsive. 5 rupees profit, dekha, 10 rupees. No. Let it either hit your stop loss or let it hit your profit 50%. Or when you profit it like went up to 30%, you see some major red candle or big candle, you expect okay, market can come that time. Very rare you can make it a practice. Or put a stop loss and put a target and leave it and wait and watch. Once you see 10 rupees, 20 rupees, don't jump and square off your position. A lot of people do that mistake. Don't do that. There are chances that market may come down slow, close to your stop loss. From there, it can go up. Right. So this is how
But
you have to play.
Kosi, when you are putting a stop loss, and if the market goes down, and if it gets executed, then there is we will not be in a position to wait for the next one, right? Once it
No,
is getting executed as stop loss.
stop loss trigger doesn't happen, but it crossed your stop loss and went down. When the market comes up, wherever you put the stop loss, it will trigger. If it doesn't
Yeah,
come till there, it won't trigger. That you have to do it manually. Okay, for example,
yeah, that's what I'm saying. So in case once you put the stop loss, and if it's getting executed, and then if it is going up, so there is a regular monitoring system which is required for that, right?
so when the stop loss is hit, that means you have squared off your position. You don't have to check anything again, right? After that.
Yeah, then if the system is going up, if the market is
Ah,
going up,
okay.
then again you'll have to put the same thing again, right? That's what I'm asking.
Same thing. I'm not understanding. Means again you have to put the stop loss. You have to say you take a new strike. The new
Yeah.
call option you take. For example, you've already taken this. You put a 10% stop loss. Okay, and you put a 50% target. So it came, market came down, hit your stop loss. That means squared off, triggered. GTD got triggered. Good still triggered. GTD got triggered, right? Nothing you have to do because your stop loss got hit. Again, you have to buy, play for next. Again, you'll buy, put a stop loss. Again, you have to play. Automatically,
Yeah.
it will not trigger. Only once it will trigger. Means once you bought this, put a stop loss, you target. Once target is hit, that's it. It is executed. It will automatically sell. You don't have to sell it. This system itself will sell it. When you reach almost 50% target, it will sell. Then after that, you don't have to do anything. If you want to further market is going up and further you feel that you can buy, then you can again place another order. Be safer side, what you can
All
do
right.
sometimes, yeah, you can put 20% depends upon your risk appetite. You want to put 20. If the market is too volatile, because now the budget is coming, the market is little volatile, too volatile. So you can put your stop loss like minus 20% or minus 30, depending upon your risk appetite. Profit you can put like 100%. Depending upon risk appetite. That's how you have to play. I hope I have answered your question.
Yes, yes.
And don't jump off. A lot of people do. Don't jump off just looking at 5, 10 numbers. A profit, let it happen. That's how you even sometimes what will happen. 50% profit. No, it can go till 40%. It'll come down. It hit your stop loss. No problem. No problem. That is part of your business. This is something like cost of doing business. That's how you learn. But a lot of times what will happen if you've done an analysis correctly, if you put a profit of 50%, 60%, let it touch there, let it close. Or you can trail the stop loss. How you do a trailing stop loss is simple. Okay, see, 25 you got it. You bought it at 223. Market went up to uh, example 300. What you'll do, you'll put stop loss in there's an option called GTT, Good Still Triggered. Okay, there what you'll put 275. You'll put a stop loss. Here percentage, but there I can't show you now. I guess. Okay, let me see if I can show. Here it is.
There is an option in the top. No, it is.
21,000. Create GTD. See this trigger price quantity. This is for stop loss target. So once from okay, 11 rupees it's showing here, no? From 11 it went up to 20. So what you'll do, your stop loss from 20, from this is for sale, sales I put, right? 1550. Okay, selling I'm talking about. Yeah, this is how it should be. Stop loss from 223. Just imagine it went up to 300. So what will put stop loss? Now you put 200, 200. In the place of 223 strike price, you put 200. What you can do when it goes to 300, you can put it 275. Target you can increase from 245 to 300 event. You can put it like 350. Here you can put 350, 75. Like this you can do. You can put trigger into strike price same, not a problem. This is how you trail. Again from 350, here the price came to 350. To stop loss, you'll put how much? 325. Like that, you can trail your stop losses. But you should do stop loss trailing. Otherwise, what will happen? Suddenly, market when it comes down, chances of you making a loss, all your profit will get eroded. All of your demat will have this option of trailing a stop loss. You can do it on a live market. That's how you have to do it. In stocks also you can do it. For example, you're buying a Wipro. Wipro, I think you can. What is the price now? Whatever it could be. 555 C I bought. Limit price. Okay. So you put here stop loss, you can put a target. In the same way, you can go to GTT, put still triggered. You can go and put there also whenever the price increases from 14.85 is the premium you have to pay. It goes up to 20, put the stop loss at 18 rupees or 17 rupees. Don't put too close because chance of hitting the stop loss is high. Keep it a little far and you can play. Stocks. Yeah, I was telling you. Actually, this option came into picture. Why? Because, for example, somebody is having a portfolio, Wipro stock is there, and a major event is coming. Yeah, I have a Wipro stock. I imagine I have 1,000 quantity Wipro. So 5 lakhs quantity hai. I'm expecting Wipro to fall tomorrow because I'm expecting, not expecting. Okay, tomorrow the results are coming out. Result could be bad. I feel so. So I want to hedge my position. They make fall by 5 to 10%. Fall. Wipro gir sakta. What I will do right now, current price is 557. So what put should I buy? If I have to buy a in the money put, what should be the strike price? Please tell me. If I have to buy a put of Wipro in the money, at the money means something around 550 or 555 would be at the money, at the price. If I have to buy in the money put, what should I buy? What strike price should I buy? Wipro. Tell me. What strike price? Yeah, tell me.
Above strike price? I mean, exactly.
Yeah, what should, yeah, above means what it should be. In the money put of Wipro. Wipro is at the money 557. So, okay, let me put like this. Wipro. What strike price? Select this strike price from here.
560, right?
560. Wipro is at 557 and I'm buying a 560. So that is in the money. Above the strike price for a put is in the money. I can buy 565, 570 also. Okay. What I will do, I will buy 1,000, yeah, for 1,500 quantity because that's a minimum. I will hedge it like this because even the Wipro falls, this price falls, my put price will go up. So I'm hedging my position. I'm expecting results are coming poor. So how can I hedge? I can hedge like this. So, and how much premium I'm paying? Okay, let me show you here. How much premium I'm paying? I'm paying very less premium. How much? Only 24,000 rupees I'm paying. But I'm safeguarding my portfolio, Wipro. In the same way, other stocks also, you can buy any news, any big events are coming, any big crash is coming. You can see right from the beginning, market is keep on crashing, falling down. If you have a stock, hedge it like this. So that what will happen? You two ways you have. One, you sell off Wipro because it's coming down, but you want to keep it. Why? Because you don't know what is a. Sometimes Wipro may fall quickly and immediately it may go up. You don't know. You're not sure, so you will hedge it. Or intraday also you can short, but the premium is more for intraday. Intraday option also you can do. Means what you can do for Wipro. See this. Buy, click on buy. The option called long term means cash and carry. You're not going long term. You want to buy intraday. I've shown you this, I think. See, if I have to buy 1,000 quantity long term for Wipro, I'm spending 5,57,000. But for intraday, I'm paying only 1,11,000. 5 times margin amount you get 5x margin amount. So with this also you can play like this. 1,000 quantity immediately buy, and you have to sell it. Sorry, not buy, sell because market is going down. You short it. End of the day, square it off. So whatever loss you made it in your Wipro stock, that you cover it here. Or if you don't have so much of funds, like I told you, you can buy a put. End of the day, square it off. If you think no, next day also Wipro is going to fall, carry it to the next day also, not a problem. You can do this. Not only Wipro, you take any Nifty 50 stocks, any stocks which has options, derivatives, options trading, you can use this. You can hedge it. For example, you are damn sure Wipro is going to go up 100% because result ekdam mast aaya, badhiya aaya. So what I have, but I have very less capital. What can I do? What I'll do? I will go and buy. So what is a Wipro in the money I have to buy? What strike price I have to buy in the money? If I have to
550,
buy Wipro expecting going up in the
555,
money,
550.
550. Yeah. So you will go and buy 550 because 557 hai, 555 also take it 550 in the money you got. So now what will happen? Wipro will increase by 3-4%. Here the call premium will shoot up like crazy. 17 will become 34, double the amount you'll get. Let's see what is the amount you're paying to buy it. You're paying like 25,000 max. 25,000 become 50,000, 60,000. So additional income you're making apart from your underlying asset. This is your underlying asset. This is your derivative. Okay. This is your underlying asset. All option derivative. Wipro is giving you some 3-4% gain. Anyway, you made money. Here also you made money. Some people what they do, they buy Wipro, sorry, Wipro future of July plus little money left. They'll buy future CE also. So they're making money in Wipro, underlying stock, derivative they got, CE made money. With future also they're making money. These are 3 options you have. Futures they put money. Futures because there is no premium erosion. Remember that. There's no premium erosion. Only marginal, okay? Call option. These are 3 ways you make money. In the same way, expecting Wipro to fall down, you can sell a future. So here sell a future. You can here you can buy a put. Initially, I told you how Wipro you can buy a put of about 570. Let me buy. This is how you do for a Wipro falling down. You know Wipro is falling down. Here you're safeguarding with buying a selling a future plus buying a put. This way you can do it. Yeah. I
So
hope.
Mathuji, I have a question that is not related to options. Uh,
Yeah.
But in general, right, I've seen a lot of the times what happens is by the time the news has reached me, the market has already reacted. I don't know where do these people get to know about these news. Are there any tools or which kind of gives me alerts that if I take Wipro, this is how, which can
Well,
based on which I can act, right?
see,
Uh,
inside information always is there. People say it's against the market rules, but it is there, right? We can't do anything about it.
Yeah.
The company CEO, the CFO, their friends will come
Yes.
to know. A lot of people will come to know. Big hedge companies will buy news from those people by paying money and all, right? So that is evident. It happens, but there are certain indicators which you can use. Not 100%, but 60-50% you may get some information. Okay, let me tell you. अभी विप्रो का है. Open the chart. You put an indicator. That's called ADX. Average directional index. Which direction the index is going? Stock. This is on a daily basis. Okay. It's going up. ADX, it shows you have another indicator which is called RSI, relative strength index of a stock. The maximum any stock is 70%, 75%, but it already touched 80% for Wipro. These are the few indicators you have which will already give you a direction. Means overbought zone, oversold zone. Overbought means बहुत लोग खरीद लिए. Lot of people have bought it. Chances of falling is too high because it's almost 80% RSI, relative strength index. Look at this ADX. ADX has already gone more than 46. It's showing strength, yeah, but look at the candle. The big candle here is it has shown result is coming on next day. This is Friday. Big candle it gave. What you can expect if the results are going to come good, the big players would have known, inside information would have known. They've already shot it here. There are two possibilities. Already Wipro went up before the result. That means 100% people will do profit booking because already went up, right? If this stock would have not gone up, it was staying somewhere here and the result comes really good, definitely it will go up. But already it shot up, it went up. So people, what they did profit booking. Plus, I don't know what will happen with the Wipro because tomorrow you'll come to know. This is few of the indicators you have to keep in mind and also look at last 1 hour. Actually, what happened in that stock? One, two, three, four, five, six. Yeah. From initial starting, the market opened with a big candle, red candle. Bearish it is. Otherwise, nowhere in the internet you'll people start writing that we go and buy Wipro, but it's going up. Nobody can give assurance, right? You have to analyze and never trust the TV. Those people will sell their stocks first, then tell you the news is going to go up because they want buyers to buy their stock when they're selling. So don't follow TV. If less channels are there or newspapers are there where you can 50 to 60% can take at face value. Otherwise, you have to draw your own chart and come up with your analysis of whether stock going up or down. You have to look at the chart, start playing around with it. You can come around with what is a match and see this is a 1 hour converted into 1 day. This also up and handle it made. See, I can easily tell. Look at this from here, it broke. correct? If it goes below this level, no, you should sell it off. If you're holding Wipro, if it crosses 546, wait and watch. This is also a little support is there here. But I would say, yeah, from here. Don't go beyond 530. Beyond 530, wait and watch. Let it come down somewhere here for support like 494 something, or then you can start acclimating slowly. Because it's overbought zone now. Wipro is at already from 80, it came down to 67. But still, if it sustains this 549, if it touches and goes up, you can keep buying it because it's a good cup and handle pattern it is making. This is how you analyze stocks. Go for a weekly. Check what's happening in a weekly. Same funda. Did a very round, then came down, going up. How you can see how much it can go up? You can check. There's a tool for that. So you use this price range. Oh, it came down from here, right? Okay, let's use this one. Okay. Where it came down till, let's take here. So chances are there from here. Same amount it can go up. It can go up to 637. This is another analysis you can do. How much the Wipro can go up? Any stock you take, if it comes down and catches up the momentum, how much it has fell down, chances are there it can go up that much. That's what the theory says. And look at the strength, RSI, look at ADX. Other lot of indicators are there which will give you guidance. Tomorrow we have even Reliance. I think we have. Look at Reliance also. Always go with 1-day analysis. Look what it says. Based on that, you can take.
Matthew, I think I have to drop, but thanks a lot. I know the whole session have been very wonderful. Lot of insights, gave me a lot of confidence, a lot of tools and tricks have been really very useful for me.
Yeah, appreciate your feedback, Chetan.
Yeah, thank you very much.
Yeah, you can use that chat. If you have any doubt, you can ask me questions. So we are done with the training. So I think next week I'm going to start another one, which is completely on options trading, A to Z of options with strategies and how you have to implement it. So I'll come up with a description on that. And if you have any of your friends, foes who would like to learn that, let me know. But they should not be a beginners. They should have basic knowledge on option trading because this is a next level course. We won't be teaching about option basics. This will be from whatever done till now. From there, it will be like how to buy strike price. What are the different strategies to be followed on options trading, option selling. Then
would that be a good continuation for us, Matthew?
Yes, definitely. That will be a good continuation for you because Here, this is like basic you learn. From here, the riding star. Riding means how to play, when not to play. See, I won't say making profit is important. I would say safeguarding your capital is important first. After that, you're making profit. That is good. Say how to safeguard your capital. Number one. Number two, how to make profit. Yeah. This is what I want to close it. Technical analysis you have to do. Second, you have to have a lot of patience. Sometimes the market will be sideways. For a buyer, no use. Seller, lot of money because premium erosion. You have to have a lot of patience. Third, risk management. If you have 1 lakh capital, don't put all the 1 lakh for buying options or selling option. No, start with 25,000 like that, then 30,000. As you improve your confidence increases, start improving your risk management. Option sizing, that is also sizing also very, very important. Means don't go and buy 18,000 quantity at the first go. Start with 50 quantity, 25, basic quantity like 100. Play around with that. Even if you lose like 2,000 rupees, 500 rupees, 600. I call it cost of doing a business. You're learning out of that. Learn. Put stop loss 10%, 20%, gain percent 100. Leave it. Sure though. If you lose how much? 1,000 rupees, you lose 2,000. But if you gain like that, you gain confidence. Option sizing and stop loss is 100%. You have to put a stop loss. If you don't put a stop loss, sometimes I told you unlimited losses can happen, or your entire capital what you put can get eroded. For a option buyer, whatever capital you put, your entire thing will go. So stop loss is very important. How you decide a stop loss? At the support. Nifty is at the support, and if it support breaks, your premium will erode. You know it will going to come down because you bought a call. You have to oblige your stop loss. You take your stop loss and keep quiet, and don't immediately jump to the next. No, market is going up. No, wait. Take a deep breath. Look at the market, how it's going for 10 to 15 minutes. Only then go into a call. Don't quickly jump. These are 5 things very important: technical, patience, risk management, option sizing, and stop loss. Very important for an option buyer or a seller. Okay. Abhishek, if you have any questions, please ask.
Yes. Srimati, I will ask you on your chat mostly.
Okay, fair enough. All right. Thank you very much, guys. If you have any questions, put me in the chat. Still the chat is functional. You can ask me there. Don't worry. As I told you, play with small amount, small sizing. Leave it to your confidence. If you did an analysis and you bought something, leave it. Sometimes it could happen that it can come down and go double the quantity, the premium up. It can happen. It happens. So follow your instincts. Okay. Thank you. Bye-bye.
Thank you.
Thank you.
And you can leave your comments, whatever good, bad, whatever comments are there in the trading Telegram. Leave it, so it's good for me and good for you also. Okay.
Thank you so much, Matthew.
Thank you. Bye bye.